Hi, my name is Jordan Wilson. Today we'll finish up our look at asset correlations. Hopefully today will be a little bit easier to digest than part 2, which was way too heavy on formulas and equations and dry numbers. So we'll try to keep this episode to a little bit more relaxed and just look at some of the overview points that you should take away from this look at asset correlations. So let's get started. So today I'd like to talk about the correlation fixation, just briefly touch on what we ended the last session with. I'd like to talk a bit about bonds with equities in portfolios, because that's always a question from investors. Discuss a bit about correlations and how they may shift over time, and finish up with a look at mutual funds or exchange traded funds. When is diversification not? We talked about fixation on correlations last episode. And I think if you want to actually just look up correlations between specific investments like Exxon or Chevron, or just the asset classes or subclasses, you can go on the internet to Portfolio Visualizer, and that has some nice tools to look at. The big thing to remember though with asset correlations is you need to compare the correlation with an asset's risk and return. Just because an asset has a negative or a low correlation with your existing portfolio, there's more to adding that asset than just the correlation. You have to look at the risk, look at the return. You'll also see that there's differences between the asset classes, and there's differences within the asset classes. So if we look at, again, just the asset classes in general right now, we see that there's currently a negative correlation between fixed income, US bonds and T-bills, to US equities. That's good. But then you have to drill down and look at the different correlations between the short term, the 1 to 3 years, the 7 to 10 year bonds, the long-term bonds, the corporate bonds. And if we look at the corporate bonds, we see that they actually have a positive 0.35 correlation with the S&P 500, whereas the other classes of fixed income are negative currently. So within an asset class, you may have some deviations, so you just have to drill down a little bit farther. You also always have to look at the asset quality. And that's not just, okay, here's the risk, here's the return, here's the correlation. You need to assess individual investments. Government bonds. Is a Venezuela government bond today the same as a US or Canadian bond? No. So again, don't just, oh, government bonds, this is the correlation, I'm going to add it to my portfolio. You always have to look at asset quality. It's the same if I'm trying to decide between Chevron or Exxon. Now they tend to move in lockstep, but if you look at the last 5 years, Chevron has outperformed Exxon as an investment against each other. So you still need to do the fundamental analyses to decide which of these assets is the better investment, not just which has the right correlation. In that same token, you also have to assess the asset fit in the portfolio. And that's your investor profile. How does that asset fit into my financial objectives? How might that asset address my liquidity needs for near-term high priority objectives? If I need to buy a house in 3 years, that plays a part in the assets that I select. What's my personal risk tolerance? Maybe commodities are a perfectly fine addition to my portfolio from an asset correlation side. But perhaps as an investor, you're not comfortable with commodities. A prime example might be private equity or venture capital. And that kind of hits all of those points I just listed. On an investment by investment basis, often venture capital might require, a 10 to 15 year time horizon. If I want to buy a house in 2 or 3 years, it doesn't matter what the correlation of venture capital against my existing portfolio is. It just doesn't make sense against my objectives, my need for liquidity, and possibly my risk tolerance, because a lot of people are not comfortable investing in venture capital. The question that often comes up is, why the heck do I want low return bonds in my portfolio? We talked about the risk return relationship previously. Equities, on average, are riskier than fixed income. And because of that, over time, equities provide higher expected return. So if I'm 25 years old or 30 years old, why do I want any bonds in my portfolio? Well, maybe you don't. Maybe at that age, 100% equities is fine. But a lot of people, even at that age, might want 80% equities, 20% bonds, 75% equities, 25% bonds. The reason for that is the correlation. Currently, US bonds versus the S&P 500 have about a 0.32 negative correlation. That means that they move in opposite directions. If the US stock market falls, that means you should expect US bonds to increase in value. It's a risk management technique. In some ways, you're hedging your equities with the bonds. And when you buy insurance or something like that to protect yourself, as in this case, say bonds, you're going to pay for that. And that comes from the lower expected returns in the bonds. You're giving yourself some comfort and some protection if US equity markets fall, because you've got a buffer to protect you from that you wouldn't have if you were 100% invested in equities. So that's why you tend to see most investment advisors recommending some portion of a portfolio in fixed income, even though they know that historically and over time, there will not be the same return levels as with equities. Another point I'd like to make is that asset correlations are not static. They can be a permanent shift, or there might be a temporary shift, one that reverses course over time. International equities used to be excellent diversification assets to US or Canadian equity funds or equities in general. And I think the correlations used to be about 0.4 to 0.5 for developed international countries. That would be Europe, Asia, Far East. Today it's 0.9. The emerging markets used to be even lower than 0.4. Excellent diversification. Today it's 0.81. Better than the developed nations, but still almost on par with our Exxon Chevron 0.85. So what happened? And why do I consider this a permanent shift? Well, I'm going to blame my friends at Starbucks, and we'll bring them back into play. Starbucks began life in 1971, single store in Seattle. In 1987, Starbucks finally expanded to Vancouver and Chicago. What Australians or Swiss drank was of really no concern to the Starbucks people. It wasn't until 1996 that Starbucks expanded outside the United States with a location in Tokyo. So 25 years of revenues solely from North America. That's diversification. They're all in essentially the United States. Switzerland, Australia, all these places. No Starbucks. By 2018, Starbucks had over 27,000 locations in 76 countries or territories. And by May 2020, they'd reached over 31,000 in 79 different countries. Today, Starbucks management cares very much about the caffeine choices and economic conditions in Australia, Switzerland, and many other countries. The same could apply to McDonald's, to Walmart, or coming the other direction, BMW. The world is shrinking. If you add in companies like Apple that do, well, Apple's trying to change slightly, but currently do almost all their production in China, there is very little uniqueness left in the globe as far as where there's not a Starbucks, where there's not a McDonald's. In the early 80s, no Starbucks, no McDonald's around the world to speak of. Now there is. So that's why it's a permanent shift, because the world has shifted. On a temporary basis, I just talked about how bonds are a great diversifier in your portfolio versus equities. That's true. And there's about a negative 0.35 correlation on average between various types of US bonds and the S&P 500. But did you know that before 1997, there was actually a positive correlation between equities and US bonds? In the mid-90s, the correlation actually almost got up to 0.75. So your diversification benefit of combining bonds with equities, yeah, there was some, but 0.75 is quite high. What's changed on a permanent basis to say that negative 0.35 is the way of the world going forward? Where will it be in 2030, 2040? If you have a portfolio, it's prudent to monitor during your periodic review process just to see where are the asset correlations today, because it may necessitate fine-tuning your portfolio. Diversified investment. We're going to get into this probably a little bit later on when we look at actual investments like mutual funds or exchange traded funds. But I wanted to point out the difference between market weighted and equal weighted funds. So a typical S&P 500 or TSX if you're in Canada index fund will be market weighted. Now what does that mean? Okay, I buy the S&P 500 or the TSX 300. I think I've got 500 companies. We just had this conversation where I can get pretty good diversification between 25 and 30 companies. Holy smoke, if I can get 500 US companies of varying cap size or 300 Canadian companies, that must be pretty darn good diversification in my portfolio. Not really. If I look at the S&P 500, the top 10 of the 500 companies makes up 28% of the fund, of the index. The top 20 make up 36%. And the top 30 holdings make up 43% of the assets. So 30 out of 500 stocks almost account for half the assets in the index. If we flip the switch here, the bottom 150 companies only make up 4% of the assets. The bottom 250, so half of the companies listed, are only 11%. And the bottom 400, 80% of the companies, is only about 29%. So you may think that you've got 500 companies and you've got great diversification, but that doesn't always hold true. If we look at equal weighted, which we don't see a ton of, that would assume that the S&P 500 has each holding only 0.2% of the assets. If it was an equal weighted fund, then the top 10 would make up 2% of all the assets, and the bottom 10 as well would make up 2%. That would give you a nice distribution between all 500 companies, and that would be great diversification. But that's not the case. So if you're looking at an investment, especially a fund product, a diversified product, make sure you know it's market weighted versus equal weighted. And then I ask the question, but is it fair? Equal weight, yeah, that reflects true diversification. But does it represent reality? The top companies on the S&P 500, Apple, Microsoft, Amazon, Facebook, Tesla, Google, Berkshire Hathaway, should they be treated the same as Gap, Xerox, Under Armour, News Corp? On an equal weighted basis, yes. But Apple is many, many times larger than these bottom dwellers, which is why on a market weighted basis, they dominate. So if you want to invest in an investment product that represents, say, in this case, the US economy, then market weight does make more sense than equal weight, because you want to have more exposure to the mega companies that drive the US economy. And I think the other question, or the other thing I'd say, is if you are looking at any mutual funds, actively managed funds, let's talk, take a look always at the top 10 holdings and the top 30 holdings. That'll give you an idea in an actively managed fund, again, how much weight is in the top 10 or the top 20 or the top 30 investments. And that'll help you identify if you have problems or potential problems with diversification in that asset. Because if the top 20 is over 50% of the fund, then maybe instead of a 400 holding fund, it's more like a 20 or 25 as far as the way you treat it from a diversification aspect. That's our look at asset correlations. I hope this was a little bit easier to digest than the previous episode. Thank you for your time and have yourself a good day.